Greetings from R.R. Vishnupriya, Assistant Professor of Commerce, Sourashtra College, Madurai 1. Here we are going to see about the introductory part of income tax. Actually, income tax is governed by the Income Tax Act 1961. So, every person in India who is liable to pay tax for the income earned in India. Before going to the concept of income tax, we must know what is tax and why it is required. Tax is a part of an individual's earning which is required to be paid to the government in order to generate revenue, and it is a mandatory liability for every citizen of the country. So every person who is residing in India is liable to pay tax. So basically, tax is divided into two types: direct tax and indirect tax. Then, what is direct tax? If the tax is paid by an individual directly to the income tax authorities, it is called as direct tax. For example, for direct tax example, we can say income tax, wealth tax is the best example. And what do you mean by indirect tax? Indirect tax is nothing but the tax which is collected by one person, and the another person will be paying tax to the income tax authorities. So directly the individual or the assessee will not be paying the tax to the government, but the mediator who is collecting on behalf of the individual, he will be collecting the tax to the government. Then comes why the government is in requirement of tax. So tax, as far as every government, every country is concerned, tax is the main source of income for the country, because it is used in initiating various welfare and other activities in order for the development of the country, such as healthcare facilities, in order to promote education throughout government schools where fees is very less, providing subsidies on part of cooking gas, fertilizers, and other essentials, and providing pension to lakhs of government employees, and for the purpose of security infrastructure development. So, we are going to see now the basic history of income tax. So, income taxes date back to the ancient times, which is mentioned in the books as Manuscripti and Arthasastra. So, Manuscripti artisans used to pay profit as tax, whereas agriculturalist is required to pay one sixth or one eighth or one tenth of their profit, depending upon the circumstances. In modern India, tax was introduced for the first times by Sir James Wilson in order to meet the laws on account of military mutiny of 1875. This was the first income tax act of modern India. Frequently, another income tax act were passed in the year 1886, 1918, and 1922. Income Tax Act 1922 was the last income tax of British and remained in force till 1962. In independent India, the Income Tax Act 1922 replaced with the Income Tax Act 1961, which implemented with effect from 1st April 1962, and it is still in force. Since 1962, several amendments means changes has been made in order to meet for the local environment and the local surroundings, which is filed by the union budget every year. So, now we are going to see the income tax basic concepts. It is passed in September 1961 and it came into effect from 1/4/2062, which extends to whole of India. The rate of IT will be given in the Finance Act passed by the Parliament every year. So, according to Professor Adams, the definition of tax is from the standpoint of view of the state. Tax is a source of derivative revenue. From the angle of the citizen, a tax is a concerned payment. From the administrative point of view, it is a demand for money by state in conformity to established rules. From the point of view of the theory, a tax is a contribution from individuals for common expenditure. So, while seeing with the features of tax, tax is a legal collection, it's a personal obligation. Personal obligation means every citizen of India is obliged to pay tax, and it is a compulsory contribution. And it is considered as an element of sacrifice and best source of revenue of collection to the government. And socio-economic objectives, tax is a contribution for common benefit of the society. It is not a contribution for tax payment. Tax is not imposed to realize cost of benefits. It may be assumed on capital or income, but they are paid out of income. Tax is actually paid by individuals, which is imposed by the government. So tax, as said earlier, is divided into direct tax and indirect tax. The best example of direct tax is income tax, wealth tax. Indirect tax, we can say excise duty, VAT, service tax, customs duty. Now VAT is replaced with GST, goods and service tax. So there are five types of persons who are liable to pay tax to the income tax authorities. Five types of persons is: first one is individual, second one is HUF, Hindu undivided family, third one is company, fourth one is firm, and the fifth one is association of persons, body or individuals, whether incorporated or not, any artificial persons, judicial persons, no, and local authority. So generally here I have mentioned seven types, but basically there are five types. That is individual, first one, second one HUF, third one company, fourth one firm, and the fifth one was AOP, any other person, etc. So the five types of persons will be earning five type of incomes. First one is income from salary, second one is income from house property, third one is income from business or profession, fourth one is income from capital gains, and fifth one is income from other sources. So income, as far as income is concerned, what do you mean by the term income? Income means profits of gains or business or profession. It may be dividend, it may be voluntary contribution received by a charitable, religious trust or university, educational institution or hospital. Value of perquisites or profit in lieu of salary taxable under section 17, and special allowance or benefit specifically granted either or to meet special expenses or for performance of duties of an officer or an employment of profit. And the next one is export incentives like duty drawback, cash complement, compensatory support, sale of license, etc. Interest, salary, bonus, commission, or remuneration earned by the partner of the firm from such firms. Capital gains chargeable under section 45, profit and gains from the business of a banking and winning from lotteries, crossword puzzles, races, horse race, card games, etc. And deemed income, amount received as PF, superannuation fund, and amount received under Keyman insurance policy, including bonus. Amount received under agreement or not carrying out activity in relation to any business or not sharing any know-how, patent, copyright, etc. Benefit or perquisites received from a company by a director or a person holding substantial interest or a relative of a director or such person. Or gift, any gift received exceeding 50,000 is taxable. Any consideration received for issue of shares as exceeds the fair market value of the shares. Any sum of money referred in clause 9th of subsection 2 of the section 56. So this is the format of computation of tax. How to compute income? So first one is income from salary, house property, business or profession, capital gain, income from other sources. The five type of incomes must be added together to get the gross total income, and less deductions under section 80 CCC to 80U, which gives the total income, tax due, less rebates and reliefs, tax payable. This format is concerned with the old tax regime, and new in as far as new tax regime is concerned, the deductions will not be come under in the new tax calculation. So now we are going to see the important terms. First one is assessee. Next one is assessment year and previous year. Third one is residential status. Fourth one is gross total income. Fifth one is deduction, and the sixth one is total income. What is assessee? One who is assessed or is liable to pay tax. According to section 27, assessee means a person to whom tax or any sum of tax is payable under the Income Tax Act. So the person is deemed to be an assessee or deemed to be an assessee in default. What do you mean by previous year? Previous year is nothing but the year starting from the 1/3 of the particular year ending to 31/3 of the year which is preceding the current assessment year. So exceptions to rule of previous year: income of person leaving India permanently or for a long time, income of person trying to alienate his assets with an intention to avoid tax, income of a discontinued business, income of a non-resident shipping companies having no representative in India. These incomes are taxed as the income of the assessment year immediately preceding the normal assessment year at the rates applicable to the former. So assessment year, the period of 12 months commencing on 1st April every year. It is the financial year immediately succeeding the previous year. So important terms, assessment year, he have given the model. If assessment year is taken as 1920 and the previous year will be 1920 and the for example, assessment year is 1920, the previous year will be 1819. So residential status, there are three types of residential status. First one is resident and the second one is non-resident. Residence means a citizen of person who reside in India for the period of 182 days or more during the previous year. So non-resident, the income earned in India only will be subject to Income Tax Act. Resident but not residing in India, citizen of India who stayed for not less than 182 days during the previous year, her income arising outside India may be taxable in India. So gross total income, what is gross total income? It comprises of all the five heads of income, and deduction means the deductions which is given by the Income Tax Act, which covers the section from 80C to 80U. Total income is nothing but the gross total income minus the deductions, which comes net taxable income. So, what is the last date of filing of the income tax return? The last date of filing for income tax rate is on or before 31st July, and with a penalty, the person can file income tax return with 5,000 rupees is 31st December and March 31st next year rupees 10,000. The total income of a person does not exceed 5 lakhs. The total fine will be 1,000 rupees. The ITR after due date, filing after due date, if the tax is payable, then the penal tax percentage of some amount of percentage will be calculated per month, which will leave it from the due date till the date of filing. So here are the some important dates for advance tax. On or before 15th June of every year, up to 15% of tax payable. September up to 45% and December 15th 75% of tax payable, and 15th March of next year up to 100% of the tax payable. So that's all with the basic concepts of the income tax. In next PPT, we will study about some more important terms which is dealt in income tax. Thank you.